Uh, want to thank all of you who've joined today, this Friday evening, and wish you all a happy and healthy 22. I'm going to keep the prepared comments brief so that you get to hear from other team members as well as leave a lot more time for Q&A. And I look forward to that. But just in terms of update, uh, the firm has grown over the last year and quarter. We're now 45,000 crores in AUM, 160 people at the firm. The split of assets roughly 75% from foreign investors, or call it 35,000 crores, and 10 to 11,000 crores from domestic investors. If we go to slide 6 now, what has helped the team generate, if we go to the previous slide, is, and I'm not going to spend a lot of time because a lot of you have heard this over and over again, but since there are new people joining on the call today as well, I just want to remind on this one slide, what helps generate strong, consistent performance over time is the focused investment culture that we have on the team, what we call performance first culture, meaning that the sole driver or objective of all of us on the investment team is to generate the highest returns for our clients compared to anyone else in the peer group. And this is underpinned or founded upon these 4 pillars, which are aligned with one another, which are the philosophy, team, process, and portfolio construction. By alignment, I mean it's a stock selection based philosophy of buying great businesses at attractive valuations. So it's a philosophy that invests in businesses rather than bets on macro or top-down approach. To go with this, we have the best team of stock pickers in the industry with strong alignment of interests with client portfolios. Implementing a time-tested process, something that's been developed over the last 25 years, at the core of which is our proprietary OpCo-FinCo analytical framework, which I'm sure most of you by now are aware of. And all along, from a risk management perspective, we maintain a balanced portfolio construction approach that consciously avoids top-down bets on macro factors and ensures that performance is a function of stock selection, which we'll see in a few minutes now. Going next to the team slide, just want to reiterate that we continue to add to what is already a very strong or stellar team, a deep bench of seasoned investors with extensive global experience in a unique team within team structure. So more or less, you can think of it as a portfolio comprising of sectoral team leaders running their sectoral funds in close coordination with one another. We go now to the slides on performance update. For the PMS net of fees, the performance for last year was around 34% compared to 31% odd for the benchmark. So nearly 300 basis points or 281 basis points net of outperformance. Satisfactory performance in light of the year that it was. Coming up to 3 years performance for the PMS strategy. Obviously, we've had other strategies which are 4.5 years old, but PMS being launched in April 19. The team continues to deliver top quartile or top decile performance. Since inception, as you'll see, 27% compounded annualized return compared to 19% of the benchmark for a little over 8% of annualized net outperformance. We go to next slide. You'll see this outperformance over the last year has been quite evenly balanced between stock selection and allocation effect when viewed from a market cap attribution perspective. Historically, longer term, and we'll share that as well, most of the outperformance has come from stock selection. Last year, it was more or less evenly split as mid and small caps did extremely well. If you go to the next slide, for last year, when viewed from a sectoral attribution perspective, all of the alpha came from stock selection. And these are the numbers, as you see here, from alpha perspective is showing 600 basis points or 6%, because remember, this analysis is gross of fees and capital gains taxes. The very first slide where we shared our performance, those were net of fees and taxes. This is gross of fees and taxes. So the entire 6% of alpha, so 38% portfolio return compared to 32% of the benchmark return, 6.3% alpha, all of that has come from stock selection, which is fairly solid across most sectors. Right? Materials shows as a key detractor, and that's primarily because we don't own any metals stock, whereas metals was one of the best performing sectors last year, after utilities, or along with utilities, which did very well with 73% rally, where also we didn't own anything in the portfolio. So utilities was and metals were two areas where we didn't own anything, and those were key detractors over the last year. If we go to next slide, you'll see the list of companies that did very well for us in the portfolio, likes of Coforge, Persistent Systems, also Bajaj Finserv, and Naveen Fluorine, and Astral and Titan contributed handsomely to portfolio performance. These stocks, as you can see, were up anywhere from 60% to 225%. On the other hand, on the right-hand side, you see stocks that hurt us. A lot of them coming from consumer staples and from financial services sector, as those two sectors were the worst performing or the biggest laggards. So Nestle, it is the second biggest detractor despite being up 8% last year. The reason is the market was up 30%. So if you're up only 8% and you're a very sizable position in the portfolio, you end up being a top detractor. Over the longer time periods, Nestle has done well for the team. But last year, it, as is usually expected of companies like Nestle, they can't keep up with markets that are up 20-30%. So that's for last year. I'll just recap since inception the performance as well. So in terms of attribution, gross of fees and tax, team delivered 104% return compared to 61 of the benchmark, 42% outperformance, of which 49 comes from stock selection. So more than 100% of the alpha has come from stock selection. And in each market cap segment, you will see very solid outperformance. Large caps, where fund managers typically are not able to generate alpha, our team has delivered 20% alpha, having delivered 80% return in large cap compared to 61% of the benchmark. In mid cap, 218% compared to 69% of the benchmark over the last nearly 3 years. And in small caps, 118% compared to 49% of the benchmark. So in each category, not only in the aggregate at the flexi cap level, but in each category of market cap, the team has generated returns in the very top of the market cap segment category in the peer group. If you look at the sectoral attribution, again, you'll see the same 104 compared to 61, 42% outperformance. Of that, 38% comes from stock selection. Here you do see a negative impact of positive contribution of about 5% from sector allocation effect. But remember, we do not try and extract returns from allocation, because our core belief is that such top-down attempts at generating value or return adds up to a big zero. They don't add a single rupee of performance, only generate risk over time and contribute to transaction costs. The focus always is on stock selection. Allocation effect over time would be a zero-sum game, not only for us, but we believe for anyone else in the peer group as well. Our team recognizes this and hence focuses its efforts on stock selection. Allocation is something just a byproduct, which we, in our balanced portfolio construction approach, seek to minimize the risk, though we never seek to zero it out. but minimize that risk. And that's what you are seeing in the performance attribution. Uh, the strong outperformers over the last 3 years are listed here, some of them common with the 1 year performers. So Coforge is the biggest contributor, but also you'll see very good mix across sectors. Naveen Fluorine from chemicals, Ipca Labs from pharma, Muthoot financials, Abbott again pharma, LTI from IT services, and so on and so forth, including Dixon, Bajaj Finserv, and Persistent. On the other hand, the biggest detractors, as you'll see from the right-hand side, again, coming from wide range of sectors, Axis Bank from financials, Delta Corp from discretionary, Indigo Paints, asset management, HDFC asset management, so on and so forth, including names from consumer sector. So what is important about these names is to note is that there's a very good distribution. You'll see among the contributors 600, 500, 300, 300, 300, 300, 300, 200, and so on. So no single name or two names have driven the whole or entire performance, right? And similarly in detractors, a very good distribution as well. Particularly the longer the time frame, the better is the distribution. What this means is the law of large numbers is well at work. And performance is coming in a very granular fashion from across companies and across various sectors and market cap segments. Generally speaking, these companies are companies that are either industry leaders or dominant players or are gaining market share in their respective industries on the back of strong execution DNA of the management, and in the process growing faster than the industry while generating superior returns on capital. And we buy them and own them as long as we believe they have a robust corporate governance and are available and trading at valuations that still leave substantial upside based on our team's OpCo FinCo framework.